Wall Street will never tell you this, but your savings right now, today, are at risk. Not someday, not in some distant hypothetical future that economists debate on cable news while sipping coffee in climate-controlled studios. Right now, the money you worked for, the savings you sacrificed for, the financial security you thought you were building, it is being quietly, methodically eroded. And the people who could warn you, they're profiting from your silence. Think about what you're seeing with your own eyes. Inflation didn't just raise prices, it robbed you. It walked into your kitchen, your gas tank, your grocery cart, and when you look to Washington, when you look to Wall Street, when you look to the financial media for answers, what did you get? Complicated charts, reassuring sound bites, and a whole lot of nothing that actually helped you pay your bills. Meanwhile, layoffs are spreading across industries that were supposed to be bulletproof. Tech, finance, media, retail. People with degrees, with experience, with decades of loyalty to their companies gone, replaced by a press release about restructuring and a severance package that doesn't even cover 3 months of rent. And rent. Let's talk about rent for a second. Or better yet, let's talk about buying a home. Because for most Americans right now, that dream has been pushed so far out of reach, it almost feels cruel to even discuss it. Mortgage rates climbed. Home prices didn't fall enough to compensate, and now an entire generation is being locked out of one of the most fundamental ways that ordinary Americans have historically built wealth. This video is not about predicting when the crash happens. I am not here to give you a date. I am not here to tell you the market drops on a specific Tuesday in a specific month. What I am here to do is something far more valuable. I'm here to give you a strategy to protect yourself before the storm hits. Whoever you are, whatever you have in the bank right now, because protection doesn't require prediction. It requires preparation. And preparation starts right now with the next 7 minutes of your life. If you're new here, this channel is Finance Stories, and we exist for exactly this moment. Hit that subscribe button right now, because what we're about to cover is the kind of conversation Wall Street hopes you never have. We break down what's really happening in the economy and translate it into real, actionable steps for real Americans, not millionaires, not hedge fund managers. You, subscribe now, and let's get into it. So let's set the scene, because context matters. You can't protect yourself from something you don't understand. And the financial media has done a masterful job of making all of this feel too complicated for ordinary people to grasp. It isn't. Let me break it down simply. For years, more than a decade, we lived in an era of what economists call easy money. Interest rates were kept artificially low. Borrowing was cheap. And that cheap money had to go somewhere. It flooded into stocks. It flooded into real estate. It flooded into speculative assets, into startups that had never turned a profit, into cryptocurrencies, into commercial real estate, into bonds. Everywhere you looked, asset prices were climbing. Not necessarily because those assets were worth more, but because there was a flood of cheap money chasing them. And here's the thing about bubbles. They feel great while they're inflating. Everyone looks like a genius. Your 401k's up. Your neighbor flipped a house and made $100,000 in 8 months. Your cousin bought some tech stock and doubled his money. The whole system feels like it's working. Like prosperity is just a natural state of things. Like the good times are permanent. They never are. When the Federal Reserve started raising interest rates to fight inflation, and they raised them aggressively, faster than they had in decades, that cheap money started drying up. And assets that were priced as though cheap money would last forever started feeling the pressure. We've already seen it in pockets of the market. Commercial real estate is under serious stress. Regional banks have wobbled. Parts of the tech sector have seen valuations cut in half. Or worse, the housing market has seized up, not crashed dramatically, but frozen. Because sellers don't want to sell and buyers can't afford to buy. Now, here's what makes this moment genuinely dangerous for ordinary Americans. It's not just that asset prices might fall. It's that wages haven't kept up with the cost of living. It's that savings rates are at historic lows because people have been draining their savings just to survive. It's that credit card debt has hit record highs. It's that the financial cushion that ordinary families are supposed to have 3 to 6 months of emergency savings. The advice you hear from every personal finance expert is simply not there for the majority of American households. Most Americans are not trading stocks. Most Americans are not sitting in front of Bloomberg terminals, adjusting their portfolio allocation between small cap value and emerging market bonds. Most Americans are trying to figure out how to pay rent, how to keep the lights on, how to cover an unexpected car repair without going further into debt. And that reality, the actual lived experience of the actual American majority, is almost entirely absent from the conversation that happens on financial television. The system was not designed with you in mind. And the sooner you accept that, the sooner you can start making decisions that actually protect you. Because here is the painful, uncomfortable truth that no one on Wall Street is going to volunteer. The financial system, as it currently operates, is extraordinarily good at transferring wealth from people who don't understand the rules to people who do. And the rules are not secret. They're just not widely shared. And that gap between what the financial elite knows and what ordinary Americans are told is exactly where the danger lives. Let's talk about that gap, because this is where it gets real. When you hear warnings about a coming recession, about a market correction, about a credit crisis, who do you think is hearing those same warnings first? Who do you think has the analysts, the data terminals, the relationships with Federal Reserve officials, the access to private research that never gets published anywhere the public can see it? The answer is the same institutions and individuals who have always had it. The major investment banks, the hedge funds, the private equity firms, the billionaires who have spent decades building networks specifically designed to give them information advantages over everyone else. And here's how that plays out in practice. When a major financial institution publicly says something like, "We're concerned about a potential market downturn," by the time that statement reaches you, sitting at home watching the news, they have already repositioned. They have already adjusted their portfolios. They have already moved capital into the assets they expect to hold value. And they have already begun reducing their exposure to the things they expect to lose value. They release the warning. You read the warning. You panic. You sell. They buy your shares at the discounted price your panic created. And then, when things stabilize and the market recovers, they've made money on the way down and on the way back up. And you locked in your losses, missed the recovery, and learned, once again, that playing their game by their rules is a losing proposition. This is not a conspiracy theory. This is just how the incentive structures of large financial institutions work. They are not evil, necessarily. They are rational actors pursuing profit within a system that rewards those with information, capital, and connections, and punishes those without. The emotional trigger that I want you to sit with for a moment is this: the fear that you're feeling right now. If you're feeling it, is being manufactured and monetized. Your anxiety about your financial future is a product. Your uncertainty is a market. And the people selling you financial products, financial media, financial advice, designed to keep you engaged and afraid they profit whether you win or lose. They profit from your clicks, from your trades, from your subscriptions, from your fear understanding. That doesn't make you cynical. It makes you informed. And being informed is the beginning of being protected. So, what do you actually do? Here is where we stop talking about the problem and start talking about the solution. Because solutions are the only reason any of this is worth discussing. If you're finding this valuable, and I genuinely believe you are, because this is the conversation that most channels won't have, do me a favor right now. Drop a comment below. Tell me, what's your biggest financial concern heading into the next year? Is it your job? Your savings? Your rent? Your retirement? Whatever it is, I want to hear it. Because that's how Finance Stories keeps making content that actually matters to you. And while you're down there, hit the like button. It takes 2 seconds. It costs you nothing. And it tells the algorithm that real people want real financial conversations. Thank you. Now let's get into what you can actually do. First, let's reframe what protection actually means. Protection does not mean hiding your money under a mattress. Protection does not mean panic selling everything and sitting in cash while inflation eats away at your purchasing power. Protection is not about fear. It is about positioning. It is about making intentional decisions now while you still have the luxury of time and choice, so that when the system experiences its inevitable stress, you are not one of the people scrambling. Step 1 is understanding what you actually have and what you actually owe. This sounds embarrassingly basic, but the majority of Americans have only a vague sense of their real financial picture. They know roughly what they earn, roughly what they spend, and they have a general feeling about whether they're ahead or behind. That is not enough. You need a clear, honest accounting of your assets, savings, retirement accounts, any property or investments, and your liabilities, debt, ongoing obligations, monthly fixed costs. Until you have that picture clearly in front of you, you cannot make genuinely strategic decisions. You're navigating without a map. Step 2 is addressing high-interest debt with the urgency it deserves. If you are carrying credit card debt at 18, 20, 25% interest, that is not just an inconvenience. That is a wealth-destroying machine running in the background of your financial life every single day. Before you do anything else, before you talk about investing, before you talk about diversification, you need to understand that paying off debt at 20% interest is the equivalent of earning a guaranteed 20% return on your money. There is no investment that reliably offers that. Eliminating that debt is the highest return financial move available to most Americans. Step 3 is building a real emergency fund. Not the idea of an emergency fund, an actual, tangible, sitting in a high-yield savings account emergency fund. 3 months of essential expenses at minimum. 6 months is better. This is not exciting. This is not the kind of thing that goes viral. But this single step is the difference between a financial disruption being an inconvenience and being a catastrophe. When the layoffs come, and in every economic cycle, they come, the people with 6 months of savings have options. They can be selective. They can wait for the right opportunity. They can negotiate from a position of stability. The people without savings take the first job that offers them anything because they have no choice. Your emergency fund is your leverage. Build it. Step 4 is genuine diversification. And I want to be specific here because diversification has become one of those words that people nod at without really understanding what it means in practice. Diversification is not owning 5 different tech stocks instead of one. Diversification means spreading your exposure across assets that don't all move in the same direction at the same time. For ordinary Americans, that means thinking beyond the stock market. It means if you are fortunate enough to have some capital to work with, considering real assets, tangible things with intrinsic value that don't evaporate when investor sentiment shifts. Land has value. Property has value. Commodities have value. Skills have value. The ability to produce, to repair, to provide services that people need regardless of what the stock market is doing, that has value that no market correction can take from you. Now, I understand that for many people watching this, buying land or investment property is not currently realistic. The whole point we established earlier is that ordinary Americans are being squeezed out of exactly these kinds of asset accumulation opportunities. So let's be practical about what is actually within reach. If you have access to a workplace retirement account, a 401, a 403, and your employer offers a match. That match is the closest thing to free money that exists in the financial system. Capture every dollar of it. That is an immediate 100% return on the matched portion of your contribution before any investment growth at all. If you don't have a workplace plan, open an IRA, Roth, or traditional. Depending on your current tax situation, there are good resources for understanding which is right for you. And I'll be covering that in detail in an upcoming video. But open one started, even small. Consistent contributions compounded over time become meaningful. The math of compound growth is one of the few things in finance that actually works in your favor when you understand it. Consider I-bonds, the inflation-protected savings bonds issued by the U.S. Treasury. They are not sexy. They are not going to make you rich quickly, but they are backed by the full faith and credit of the federal government. They adjust for inflation, and they are completely accessible to ordinary Americans. In an environment where protecting purchasing power is the priority, they deserve a place in your thinking. Think about your skills as an asset class. This is something the financial industry almost never talks about because you can't sell a commission on it. But your ability to earn your human capital, your professional skills, your expertise is the most valuable financial asset most people possess. And unlike a stock portfolio, it cannot be wiped out in a market crash. Investing in your own skills, your own earning capacity, your own professional development is not a soft, feel-good recommendation. It is a hard-headed financial strategy. A person who earns 30% more because they developed in-demand skills has done more for their financial security than a person who agonized over portfolio allocation on assets they can't afford to lose anyway. And finally, and this is perhaps the most underrated protection available to ordinary Americans' community, financial resilience is not just individual. Humans are social creatures. And throughout history, the way ordinary people survived economic hardship was through networks of mutual support. Neighbors helping neighbors, families pooling resources, communities sharing skills and knowledge. In an economy that increasingly tries to monetize every human interaction, the relationships and networks you build with people you trust are a form of wealth that no financial crisis can take from you. You do not need billions to protect yourself. You do not need inside information. You do not need a sophisticated financial advisor or access to investment products that ordinary people can't reach. What you need is clarity about your actual situation, discipline to make intentional decisions, and the willingness to prioritize long-term stability over short-term comfort. That is what Wall Street will never tell you, because it doesn't make them any money. So here is where we land, and I want you to really hear this, because it matters. The crash, if it comes, when it comes, in whatever form it takes, is not the end of your story. Economic disruptions are not new. They have happened before. They will happen again, and every single time they have happened throughout history. There were people who were devastated and people who came through and rebuilt, and in some cases, even thrived. The difference between those two groups was almost never about how much money they had going in. It was about how prepared they were. It was about the decisions they had made in the months and years before the quiet, undramatic, unglamorous decisions to get out of debt, to build savings, to diversify, to invest in skills, to build community. The reset, because that is what economic downturns ultimately are. Painful and disruptive and genuinely harmful to real people. But ultimately, a reset creates opportunities for those who are positioned to see them. Crises fall. Assets become affordable. The people who kept their financial house in order, who didn't panic sell at the bottom, who had cash available when others were desperate. Those are the people who come out the other side stronger. That can be you, not because you're special, not because you have advantages that others don't, but because you made the decision to be informed, to be intentional, and to act before the crisis rather than during it. The question is not whether you'll face financial challenges. You will. Everyone does. The question is whether you'll be prepared and whether you'll face those challenges from a position of clarity and stability or from a position of panic and regret. Start today. Not tomorrow, not when you feel more financially secure, because that feeling of security is a moving target that recedes as you chase it. Today, even one step, even just writing down your assets and your debts and looking at the real picture, even just opening a high-yield savings account, even just capturing your employer's full 401k match, one step taken today is infinitely more valuable than a perfect plan that never gets started. If this video gave you something, a new way of thinking, a practical step you're going to take, a sense that maybe you have more agency over your financial future than you thought, I want to hear about it. Drop a comment below right now. Tell me what you're going to do differently. Tell me what you want me to cover next. Every single comment helps finance stories reach more people who need exactly this kind of conversation. And the likes do the same thing. So, if this was valuable to you, show it. It literally helps us keep making content like this for free for everyone. And speaking of what's coming next, the video appearing on your screen right now is one you do not want to skip. We're going in deep on something that directly connects to everything we just talked about. And it's going to give you the next layer of practical strategy that turns everything in this video from theory into a real, executable plan for your financial life. Watch that next. Share this one with someone who needs it. And remember, protecting your money starts now, not when the headlines get scary. Finance Stories is here every step of the way. Let's go.